If you're checking your bank balance to make decisions about your business, stop. You're flying blind. Today, on What is Accounting and How Do I Do It, we're talking cash basis accounting versus accrual and why you should be using accrual accounting. Before I jump in, I'm Sean. I've been a CPA for 13 years, and in that time, I have grown increasingly frustrated at the gross lack of accounting and finance educational resources available to small business owners. That's why I started Ledger Ready. If you're looking to get a quick budgeting solution right away to get started on the right path, subscribe to my newsletter at ledgerready.work and I'll send you a workbook completely free. Now, your bank account only tells you one thing: how much cash is sitting there right now. It doesn't show you what bills are about to hit. It doesn't show you what unpaid invoices are coming in. And it definitely doesn't tell you if you're actually making a profit. I've seen small business owners make big hiring and spending decisions just because they had cash in the bank, and a month later they're scrambling. That's why you need to be looking at your income statement and cash flow forecast, not just your bank balance. If you're serious about understanding your numbers, you've got to move beyond just looking at your bank account, and that's where accrual accounting comes in. Now, I've talked about this a lot in some of my past videos, but today I really want to dig into the difference between accrual and cash basis accounting. Most small business owners use cash basis accounting by default. It's simple. You record income when you get paid, and you record expenses when you pay them. That works fine when you're just starting out. But as your business grows, cash basis can give you a dangerously distorted view of your financial health, especially if you're paying a lot of bills and the timing of the payment varies. That's why larger and more financially savvy businesses use accrual accounting. Accrual accounting means you record income when it's earned and expenses when they're incurred, not when the money actually moves. Let's break that down a little bit more. If you send a customer an invoice in May, but they don't pay you until June, accrual accounting says you record the revenue in May, assuming you delivered the product or service in May. The fact that your cash hit your bank account in June means nothing. May is when the sale actually happened. Same goes for expenses. If you get a bill for rent or software or utilities or whatever it may be in March, but you don't pay it till April, you still record the expense in March, assuming that's when you received the benefit of the service. Why does this matter? Because cash flow and profitability are not the same thing. You could have a huge spike in sales in 1 month and think business is booming, only to realize later that none of those invoices were paid on time, and maybe not at all. Or worse, you might think you're profitable because there's cash in the bank, but in reality, you're carrying a huge load of unpaid bills. Accrual accounting gives you a more accurate picture of your business performance because it matches income to the expenses related to that income. And this I've talked about quite a bit in my videos, and it's called the matching principle. It is the core idea of double entry accounting and is critical that you understand it. So let me give you an example to really drive this home. Let's say you run a product-based business and you buy $10,000 of inventory in January. Under cash basis accounting, that's a huge January expense because you would just expense 100% of that inventory payment, $10,000, all in January, even though you haven't sold anything yet. With accrual accounting, that $10,000 of inventory sits on your balance sheet as inventory. So the accounting term for that is you capitalize the inventory, which means that you record the inventory as an asset. You only deduct the cost of that inventory as you sell the products. That way, your income accurately reflects how much it costs you to earn each dollar of revenue. So as you sell the inventory and record the revenue on your income statement, you also recognize the expense specifically related to the items of inventory you sold, and that is called COGS. You've probably heard that term quite a bit. It's COGS, and it stands for cost of goods sold. Bottom line, if you want to truly understand profitability, forecast your cash needs, and make smarter decisions, accrual accounting is critical and is, in my opinion, the only way to go, unless your business collects primarily cash receipts at point of sale, in which case cash basis accounting might make sense for you. But trust me, those are very limited situations, and almost every single business should be using accrual accounting. It might take a little bit more effort or working with a bookkeeper to do this, but trust me, it gives you the clarity you need to lead your business like a real CEO, not just a hustler watching a bank balance. All right, I hope this was helpful to you today. And if you're interested in future videos, subscribe to my channel. And like I said at the start, if you want to get started right away with this and get going with budgeting the right way, I have a free workbook that I put together myself, and I make it available to everybody who subscribes to my newsletter, which you can find at ledgerready.work. Okay, that's all for today. I'll see you next time.